mean, it essentially broke the y-axis. It smashed right through that $5,500 per ounce ceiling.
Yeah, which is just staggering to look at on a chart.
Right. We're looking at an asset that capped off its strongest annual performance since, like, 1979. It was up 64% in 2025, and then it just kept running, adding another 20% early this year.
Just relentless momentum.
Exactly.
Yeah.
But here is the puzzle for you. A macro gold rush does not automatically mean gold mining companies get rich. Usually the exact same inflation that drives up the price of gold also drives up the cost of labor, diesel, steel, and it just eats the miners alive.
Yeah, history is full of miners going bankrupt during a gold bull market.
Exactly. Yet we are looking at a stack of sources today centered around a highly detailed 2026 financial and operational report on Kinross Gold Corporation. And they haven't just survived this inflationary cycle, they have somehow turned it into literally billions of dollars in free cash flow.
It really forces a complete recalibration of how we view resource extraction. I mean, what we're seeing in this Kinross report isn't just a corporate success story.
Right.
It is a real-time ledger documenting a structural shift in the global financial system. The very definition of what constitutes a safe asset is being rewritten right now, and, well, this company has positioned its operational machinery to capture that shift perfectly.
Okay, let's unpack this, because before we can dive into the actual engineering of Kinross's specific mines, we really have to understand the macro environment. I mean, gold is suddenly trading like a hypergrowth tech stock.
Yeah, it really is.
What is the actual mechanism fueling this? Because our sources point to two very distinct, massive engines driving this new reality, resetting the baseline to somewhere between $4,500 and $6,000 an ounce.
Well, the first engine is structural, and it's just relentless. It's emerging market central banks.
Yeah.
They are actively diversifying their foreign reserves away from the U.S. dollar, and they aren't just, adjusting spreadsheets.
They're not just buying paper.
Exactly. They are taking physical delivery of an estimated 60 tons of gold every single month. When sovereign nations buy physical assets at that sheer volume, it creates a concrete floor under the price. I mean, they are systematically de-dollarizing.
60 tons a month of physical metal actually leaving the market. That changes the supply dynamics entirely.
It absolutely drains the vaults.
But the sources highlight a second engine that feels, much more aggressive. Analysts are calling it the debasement trade. And this isn't about foreign central banks. This is happening right here in Western markets.
Yeah, the debasement trade is a direct mechanical reaction to Western fiscal instability. We are seeing wealthy individuals, family offices, large institutional investors. They are hoarding physical gold and just pouring capital into gold-backed ETFs.
So piling in.
Right. Just since early 2025, Western ETFs have added 500 tons to their vaults. And to understand why, you really have to look at the alternative. Historically, if you wanted a safe yield, you bought sovereign bonds.
Sure, the standard 60-40 portfolio logic.
Exactly. But when investors lose faith in the underlying fiat currency, like when they fear the currency itself is being debased by runaway national debt, well, bonds are no longer safe. They want a hard asset that cannot be printed.
Which explains why Wall Street is scrambling to update their models. I mean, JP Morgan is targeting $6,300. UBS is that $6,200. Goldman Sachs just lifted their target to $5,400.
The revisions are happening constantly.
But this brings me back to my initial puzzle. If everyone, from central banks to billionaires, is buying gold, how does a mining company specifically capture that? I mean, think of it like owning the only umbrella factory during a never-ending monsoon.
Okay, I like that.
You are going to sell a massive amount of umbrellas, sure, but the cost of the canvas, the metal spokes, the labor to assemble them, that's all going to skyrocket because of the storm.
That umbrella factory is the perfect analogy to explain a critical concept in mining. What's fascinating here is a mechanism called unhedged production.
Okay, unhedged production. Break that down.
So historically, mining is so incredibly capital intensive that companies are forced to take out massive loans just to build the mine in the first place. And to satisfy the banks, the mining company will hedge their production.
Meaning they lock in a price.
Exactly. They sign contracts agreeing to sell their future gold at a fixed, predetermined price. It guarantees they can pay their debt, regardless of what the market does.
Ah, so if gold goes to $5,500, a hedged miner is still selling it at, say, $2,500 because they signed a contract 3 years ago.
Right. They completely miss the monsoon.
They sell cheap umbrellas while everyone else is paying a premium.
Precisely. But Kinross operates with unhedged production. They didn't lock in those advanced sales contracts. So when the spot price of gold goes parabolic, every single dollar of that price increase drops straight to their top line.
Wow.
They are fully exposed to the spot price, which creates this exponential operational leverage.
And when you look at what that operational leverage does to a corporate balance sheet, the 2025 numbers for Kinross just look like a financial tsunami.
A literal wave of cash.
We're talking about $2.39 billion in reported net earnings. That is a 151.9% jump. And their attributable free cash flow hit $2.47 billion. But what fascinated me in the financial analysis wasn't just the sheer volume of cash, it was how aggressively they used it to insulate themselves.
Yeah, they executed a total transformation of their financial architecture. I mean, in an industry notorious for carrying crushing multi-billion-dollar debt loads, Kinross took that free cash flow and retired $500 million in senior notes early.
Just wiped it off the book.
Right. They didn't just pay down debt, they practically eradicated it. They shifted to holding a $1.0 billion net cash position.
That is wild. $1 billion in net cash, with total liquidity sitting at $3.5 billion. I saw their debt-to-equity ratio is down to 8.72%.
Which is unheard of for a miner. Exactly. For a company that relies on heavy machinery and explosives, that balance sheet looks like a software company. But let's bring it back to the reality of the dirt. What about the cost of making those umbrellas? Because the report is very clear that industry-wide inflation is a massive problem.
It absolutely is, and we have to look at the metric that matters most here, AISC, or all-in sustaining costs. This factors in everything: labor, diesel for the massive trucks, cyanide for processing, royalties, sustaining capital. The inflation in those inputs pushed Kinross's 2025 AISC up to $1,571 per ounce.
Which is a real tangible increase. But when you are selling unhedged gold at $5,500,
the math is just staggering. In the fourth quarter of 2025, Kinross's operating margin was $2,847 per ounce.
Good grief, almost $3,000 an ounce in profit.
Yeah. And what's really compelling is the stress testing in the report. They modeled a pessimistic 2026 scenario where inflation runs incredibly hot, pushing their AISC all the way up to $1,730 per ounce. Okay, so the worst-case scenario.
Right. But even in that worst-case setup, with gold holding above $5,000, they are still clearing over $3,000 per ounce in pure margin.
So the margin expansion just outpaces the cost inflation entirely.
By orders of magnitude. But, you know, having a pristine balance sheet and great margins on paper means nothing if you can't actually deliver the physical metal.
All right, you still have to dig it up.
And their target for 2026 is ambitious. 2 million ounces. To hit that, they have to physically move a staggering amount of earth across some vastly different geological and political environments.
Which requires serious geographic diversification. I mean, they have operations distributed across the U.S., Mauritania, Brazil, and Chile. Let's dig into the mechanics of how they actually pull this off, starting with the United States.
Okay, let's look at the U.S.
They are projecting 685,000 ounces from the U.S. in 2026. And the key to this seems to be a joint venture in Alaska called Manh Choh. The mechanics of this project remind me entirely of the hub-and-spoke model used by major airlines.
The hub-and-spoke comparison is very apt here. Walk us through how that actually applies to an Alaskan gold mine.
So normally, when a company finds a high-grade gold deposit, standard operating procedure is to build a massive processing mill right on top of it.
Right at the source.
But building a mill is a nightmare. It costs hundreds of millions of dollars, takes a decade to permit, and requires building massive tailings dams that tear up the local environment. With Manh Choh, they are mining on native Tetlin land. Instead of building a destructive new mill at the spoke, they just mine the high-grade ore and physically truck it over public highways to their existing Fort Knox mill near Fairbanks.
Which acts as the hub.
Exactly.
So they are bypassing the need for new processing infrastructure entirely.
Yes, and the compounding benefits of that single logistical decision are huge. They save massive amounts of capital up front. They drastically reduce the environmental footprint, which is exactly why the local native leaders actually support the project.
That's a huge win in mining.
It is. Plus, the report highlights that the trucking and mining operations create 400 to 600 high-paying year-round local jobs. It turns a potential environmental battleground into an incredibly efficient, cash-flowing operation.
It's a masterclass in capital efficiency. You use existing sunk costs, the Fort Knox mill, to process new high-grade ore. But, if we pivot from the frozen roads of Alaska to the Sahara Desert, we see a totally different mechanical challenge.
Yeah, let's talk about their operations in Mauritania, specifically the Tasiast mine.
Tasiast's a fascinating case study. The report notes this is their highest margin mine globally. The 2025 cost was just $884 per ounce.
Wow.
And they are projecting over 505,000 ounces from it in 2026. But operating in West Africa is not exactly a walk in the park.
Far from it. I mean, the geopolitical and labor risks there are historically very high. Didn't Kinross suffer major, crippling labor strikes at Tasiast a few years back?
Yes. In 2016 and 2020, they were dealing with intense friction from both the unions and the state. But they solved a significant portion of that friction through a major infrastructure pivot. They integrated a 34-megawatt solar power plant paired with an 18-megawatt battery system directly into the mine's grid.
Okay, so they went green. But how does building a solar farm stop a labor strike or ease geopolitical tension?
Because it wasn't just an environmental PR move, it was an economic and political alignment. Before the solar plant, the mine relied heavily on imported heavy fuel oil.
Expensive and dirty.
Right. By switching to solar, Kinross drastically cut their operating costs and insulated themselves from global energy price spikes. But more importantly, it aligned perfectly with the Mauritanian government's national sustainability vision.
Oh, I see.
They relieved pressure on the national energy infrastructure and reduced national greenhouse gas emissions. When a foreign mining company actively solves a host country's infrastructure goals, the regulatory and labor friction tends to smooth out significantly. They turn a vulnerability into a strategic partnership.
That makes perfect sense. You basically embed yourself into the country's success. Now, if Mauritania is about geopolitical alignment, their operation in Brazil, the Paracatu mine, is purely an engineering marvel.
It really is.
When I looked at the numbers for Paracatu, they seemed almost impossible. The grade of the ore is 0.424 grams gold per ton of dirt. To visualize that, a standard paperclip weighs about 1 gram.
So less than half a paperclip.
Exactly. They're extracting less than half a paperclip's worth of gold from a literal ton of solid rock. How does an operation like that not just bleed money?
Paracatu requires a completely different operational philosophy. It is the ultimate exercise in economies of scale. When your ore grade is that low, you cannot rely on finding rich veins of gold. You have to practice bulk tonnage mining.
So it's just about volume, moving mountains as fast and cheaply as possible.
Exactly that. The physics and chemistry of the operation have to be dialed in to absolute perfection. We are talking about fleets of autonomous, massive haul trucks moving millions of tons of earth, feeding into grinding circuits that operate with relentless efficiency.
As if every penny counts.
Every fraction of a cent saved in the crushing and chemical recovery process matters. Because they have refined this bulk process so meticulously, they actually achieved a 25% production bump in the fourth quarter of 2025 just by optimizing throughput.
That's incredible.
Yeah, they are targeting 600,000 ounces in 2026 from rock that most companies would consider outright waste.
It's incredible what high prices and flawless engineering can achieve. Okay, so we've established they have a fortress balance sheet, and we've toured the geographic engines currently printing that cash. But if you are a listener trying to understand the long-term play here, you have to look at their $1.5 billion capital expenditure budget.
Right, because mining is a depleting business.
Exactly. A mining company is constantly depleting its own assets. Every ounce they mine is an ounce they don't have tomorrow. How are they guaranteeing their future?
That entire future hinges on a single massive development in Ontario, Canada, called the Great Bear Project. It is arguably one of the most vital, undeveloped gold assets on the planet today.
Here's where it gets really interesting. In mid-February 2026, the Ontario government granted Great Bear a specific fast-track status called One Project, One Process. And this isn't just, bureaucratic reshuffling. It completely alters the timeline of the mine.
It's a game changer.
Normally, permitting is sequential. You spend years fighting for a water permit, then you apply for an air permit, then land use, and so on. It can stall a project for a decade. This fast-track status makes the process concurrent, slashing the red tape from 10 years down to essentially 2.
And that regulatory acceleration fundamentally rewrites the valuation model for Kinross. Let's look at the preliminary economic assessment for Great Bear to understand why this matters. This is a Tier 1 asset. We're looking at a 12-year initial lifespan, capable of producing 518,000 ounces a year starting in 2029. But the most important number is the estimated all-in sustaining cost, $812 an ounce.
Wait, an $812 cost against a $5,500 gold price?
Yes.
The net margin there is going to be astronomical.
It is projected to be one of the highest net margin operations in the Northern Hemisphere. It sits in a safe, Tier 1 jurisdiction, with the government actively pushing it forward.
So let's step back and look at the whole picture for a second. You have zero net debt, you have $1 billion in cash, you have massive margins across your current global operations,
Yeah.
and you have a fast-tracked, low-cost supermine coming online in Canada.
It's a perfect storm.
Right. So if you are listening to this, the immediate assumption is that Kinross stock must be priced to absolute perfection. It should be wildly expensive, trading at a massive premium. But when we dive into the peer comparison and the sources, there's a glaring disconnect.
The market valuation does not align with the operational reality. Let's contextualize this by looking at their primary competitors. Barrick Gold, for instance, is currently wrestling with severe geopolitical instability in Mali, which has caused tangible production slowdowns.
Right. Lots of headlines there.
Consequently, Barrick's projected 2026 costs are soaring, estimated to land between $1,760 and $1,950 an ounce.
Ouch.
Then you have Newmont, the biggest player in the space. Their output actually dropped 14% year over year, and they've been forced to halt operations entirely at certain mines in Mexico and Papua New Guinea due to various disputes.
So while the competitors are shrinking and getting more expensive, Kinross is hitting targets, lowering debt, and expanding margins. But how is the market actually pricing that outperformance?
The report shows Kinross trading at a forward price-to-earnings ratio of around 11.1x. That is significantly below the broader industry average, and it's even below Kinross's own historical 5-year average. Furthermore, consider their return on assets, or ROA.
The report clocks their ROA at a massive 19.11%, which, for a mining company, seems like an anomaly.
It is a massive anomaly. Mining is incredibly capital intensive. You spend billions on infrastructure just to get to the starting line. Generating a 19% return on those heavy assets indicates hyper-efficient capital allocation.
It's wild.
The market is currently pricing Kinross as if it carries the traditional heavy risk profile of a standard miner, completely ignoring the fact that they are operating more like a cash printing utility.
But analysts must be noticing this.
Analysts are catching on, though. The consensus target price is averaging around $40.89, implying a 33.7% upside. Major institutions like Bank of America and Scotiabank are actively upgrading them because the retail market simply hasn't digested the Great Bear Fast Track or the unhedged leverage.
It is a compelling bullish case. But as we know, extracting resources from the earth is an inherently dangerous, unpredictable business. Things go wrong. A rock face collapses, a chemical spills, a government changes its mind. What is the bear case here? How are they mitigating the severe environmental and regulatory risks that typically derail mining stocks?
They are relying heavily on advanced operational technology, which falls under their ESG, environmental, social, and governance initiatives. And we need to be clear, this isn't just about corporate goodwill.
Right, it's not just a brochure.
No, it is a hard-nosed strategy to keep their cost of capital low and prevent devastating regulatory shutdowns.
The tech deployment detailed in the sources is fascinating. Let's talk about water first. Mines use massive amounts of water for processing. Kinross is currently recycling 75% of their water, with a firm operational target to hit 100% recycling at their core sites by 2026.
Which eliminates a huge point of friction with local communities.
Absolutely. But what really caught my eye is their use of AI. The report says AI and automation have already reduced waste by 12%. How does an algorithm actually reduce physical rock waste?
It comes down to predictive maintenance and algorithmic ore sorting. Instead of just grinding every single piece of rock that comes out of the pit, they use advanced sensors and AI models to analyze the chemical composition of the ore on the conveyor belt in real time.
Oh, wow. So as it's moving.
Right. The AI identifies and separates the barren waste rock before it ever reaches the energy-intensive crushing circuits. You save massive amounts of electricity and cyanide, and you process only the profitable rock.
That is incredibly efficient. And they are also deploying blockchain technology to track the physical gold itself. By creating an immutable digital twin of every gold bar, They can prove its ethical origin, proving it wasn't mined using child labor or used to fund a conflict.
Which is brilliant.
Right, because that traceability is becoming a mandatory requirement for the big institutional buyers driving the debasement trade. But even with all this tech, there have to be lurking risks that keep the executive team awake at night.
Well, if we connect this to the bigger picture, the structural risks are persistent. First, geopolitics. Yes, the solar project in Mauritania smoothed over relations, but operating a highly lucrative asset in West Africa is always a geopolitical tightrope. A sudden regime change or a renewed union dispute can halt production overnight, severing a major artery of their cash flow.
Or what about domestic risks? Even in quote-unquote safe jurisdictions, regulations can bite.
Absolutely. In the U.S., for example, they are subject to strict environmental frameworks like RCRA, the Resource Conservation and Recovery Act. If a sensor fails and a local regulatory body flags a hazardous waste issue involving cyanide or tailings, operations can be frozen instantly. The remediation costs alone can run into the hundreds of millions.
The source material also flags M&A mergers and acquisitions as a primary risk, which seems counterintuitive. I mean, they have $1 billion in cash.
Yeah.
Isn't buying another company a good thing?
It's the risk of integration. When you have a pristine balance sheet, the temptation is to deploy that capital by acquiring a smaller mining company. But M&A is notoriously difficult.
Too many unknowns.
Yeah. You might buy a mine only to discover hidden title disputes with local communities, or worse, inherit another company's poorly managed environmental liabilities, like a failing tailings dam. A bad acquisition can destroy a clean balance sheet overnight.
That makes sense. It's the risk of buying someone else's hidden problems.
Mm-hmm.
So what does this all mean? If we synthesize everything we've uncovered in these sources today, from the macroeconomic shift driven by central banks, to the hub-and-spoke ingenuity in Alaska, to the concurrent permitting of Great Bear, what is the core takeaway for the listener trying to navigate 2026?
The core takeaway is that Kinross has engineered a very rare operational hybrid. On one hand, the company acts as a premium defensive asset. Because its sole product is physical gold, holding Kinross naturally insulates an investor against the fiat currency debasement and inflation that is terrifying global markets. But on the other hand, it isn't just a static vault.
Right, because of the unhedged leverage and the massive net cash position, they aren't just holding a safe asset. They are an active, highly tuned engine compounding it.
Exactly that. They have mathematically structured the company to not just survive the gold rush, but to multiply the underlying gains of the asset itself. And that brings me to a final thought I want you, the listener, to mull over long after we wrap up today. We began by examining the macro forces sovereign nations and billionaires aggressively swapping their paper dollars for physical gold.
A fundamental flight to hard assets.
Right. Consider the position of a company like Kinross in that landscape. They carry zero net debt. They operate with AI-driven, hyper-efficient machinery across multiple continents. And their entire business model is pulling the exact asset that the world's most powerful institutions are fleeing toward out of the earth at a 50% profit margin.
Yeah.
In a global economy losing faith in fiat currency, a company that physically prints gold from the dirt isn't just a traditional mining stock anymore. It begins to function almost like a privately operated central bank.
A private central bank. Wow. That completely changes how you view a mining company.
So the question I leave you with is this. As the global financial paradigm definitively shifts away from paper promises and toward verifiable hard assets, where will the ultimate economic power in the next decade actually lie? Will it remain with the sovereign nations that print the money, or will it shift to the companies that possess the machinery to mine the alternative?
That really forces you to look at that vertical $5,500 chart in a completely different light. It's no longer just a price going up. It's a real-time ledger of a massive transfer of power. Thank you for joining us on this deep dive. Keep questioning the numbers, keep digging into the mechanics of the sources, and keep exploring the forces shaping the world around you. We'll catch you next time.